Okay, here we're going to be looking at changes in the value for a balance sheet accounts purchased in a business acquisition here. An example is where Corp A acquires or buys Corp B. Corp A exchanges their stock for Corp B's net assets. So let's look at Corp B's balance sheet here. For this acquisition here, Corp A must establish accurate values here for these balance sheet accounts that they purchased here from Corp B. That's their assets and their liabilities here. This requires a period of time. So looking at our example here, Corp B had a book value here. That was their carrying value, and that we know here at the acquisition date, so we know those values here. For our acquisition method here, Corp A, the buyer here, must establish a fair value for these accounts here at the acquisition date here. And in this case, we're using the acquisition date of October 1st of the X1, the first year here. And over time, Corp A can refine these or revalue these accounts based on better information than they had here at the acquisition date. And for example here, Corp A revalues these accounts here on 2/1 of X2. That would be the following year. That would be 5 months after the acquisition date. Okay, in business acquisitions, we have a measurement period here. That's the period for revaluating or adjusting these balance sheet accounts. And that's from the time of the acquisition date, in this case it was 10/1 of X1, until no better information is available. That is, we have the best information that we can obtain, and that cannot exceed 1 year. And for our revaluation date, in this example, it was 2/1 of X2, that would be the following year. Now, during this measurement period, the values assigned here to these accounts at the acquisition date here are provisional values. That is, they can be adjusted based on better information. But any changes in value caused by events that occur after this acquisition date here are not included in any adjustments. They would be adjusted to the income in the period which they occur. So what we're adjusting here are these accounts here based on the acquisition date values. So any events that occur after this acquisition date here for the corporation we're buying, those would have to be included in a separate income statement or balance sheet and income statement, but would not be included here in the acquisition date values. So these revaluations or these revised amounts for the acquisition date here could include new assets discovered as well as any adjustments to better reflect here the value of these accounts. Okay, let's look at how this revaluation here can affect the goodwill here in this business acquisition. Now looking at our asset accounts here for the example I'm going through here, we had an increase here in our building account from $290,000 to $320,000. And then we also had an increase here in our equipment account from $145,000 to $160,000. So that revaluation here increased our total assets account of total assets here from $860,000 to $905,000. Now looking at our liabilities here, well, the only change was in our warranty liability, where it increased from $10,000 to $25,000. So our revaluation here for our liabilities was $155,000, and for the acquisition date it was $140,000. So we had an increase here in $15,000 for the total liabilities. Now going through a value analysis here, the fair value of these net assets, that would be the revaluation amount here for our total assets here of $905,000 compared to our revalued amount here for our total liabilities of $155,000. So the difference between the two here is $750,000 here for our fair value of our net assets. Now to determine our goodwill here, we look at the price that we paid. Now that stayed the same here. We're still offering $800,000 worth of common stock to Corporation B for their net assets. That is, Corporation A's offering $800,000 here in their common stock to Corporation B for the net assets. And the fair value of those net assets that we're receiving here, we calculated at $750,000. So the difference between the price paid and the fair value of the net assets here would be $50,000, and that would be what we recognize here as goodwill at this revaluation date here. And comparing that to the acquisition date, we had a goodwill of $80,000 here that we calculated, and now it's adjusted down here to $50,000. So we had a change here of $30,000 in goodwill. Okay, one last point here on this goodwill. Goodwill is something that we have to calculate in a business acquisition or a business combination. And normally the goodwill here can absorb any changes here in our revaluations of our assets and our liabilities. But in the event that we've done a revaluation here and the fair value of our net assets that we receive is greater than the price that we paid here, we wouldn't have any goodwill. We'd have a negative goodwill, but instead we'd have to recognize a gain here on this business acquisition, and that gain would be recognized here at the end of the measurement period for this business acquisition. Okay, looking at our journal entries here for this revaluation here of our assets and liabilities here on February 1st of the second of X2, or the second year here. Well, they would be based on the changes here for that time period of October 1st through 12/31 of the first year here. The financial statements for 20X1, or that first year, would have to be restated to include these revised amounts. So looking at our buildings account here, we would increase that by $30,000, that increase in our buildings account. And then we'd also recognize depreciation on that building in this case. And that would be only for the 3 months here recognized for that first year. And that would, in this case, was $1,500. And then for our equipments account, we increased that by $15,000. And the same thing for its depreciation. We just recognize that for the 3 months here in that first year, from that October 1st to that 12/31 time period. And then we'd also increase our warranty liability expense here by $15,000. Now the point I want to make here is that we have to adjust here our returned earnings. In this case, it would be for that depreciation expense. We'd have to recognize that retroactively for the 3 months here for that first year of 2021 X1 year. That would be that October 1st through the 12/31 time period. And we'd also have to adjust the retained earnings for any other changes that would have been included in that first year time period. So the point I'm making here, these final financial statements for 20X1 here would have to be restated here to include the revised amounts based on a revaluation here of 2/1 or February 1st of the second year.